Tritium just put out their annual earnings report this morning, and the stock fell 8.2% by the end of the day. This follows several weeks of Tritium's stock declining, and currently they're trading for about 51 cents per share at a $78 million market cap. So is this a good opportunity to invest in Tritium, or is this something you should be staying away from? The company had two major highlights for this report. One of those was their revenue growth. For the full fiscal year of 2023, that being June 30th, 2022, until June 30th, 2023, Tritium's revenue grew 115% year over year, which is absolutely awesome revenue growth. But then, for the first half of the calendar year 2023, so January 1st until June 30th this year, Tritium's revenues grew 286% year over year, which is even more impressive. Their revenues for the first half of the calendar year were $112 million, and they managed to get a gross profit of 4% compared to negative 18% for that same time period 1 year ago. They also gave revenue guidance for the full calendar year of 2023. They said those would come in between $210 and $225 million. And you might notice that compared to the $112 million they said for the first half of the year, the second half of the year would be between like $98 million and $113 million. So it sounds like they're kind of expecting their revenues to remain relatively flat, if not slightly decline as the year goes on. Historically, Tritium's revenues have tended to increase as the year goes on, and this was brought up during the question and answer segment of the earnings call today. And Tritium's explanation for why these revenues are remaining relatively flat throughout the year was that they had better than expected revenue in the first half of the year, which I thought was kind of a weird explanation. They kind of went on with some reasonings to kind of back up that statement, but I thought it was kind of weird, especially when we think about ChargePoint's earnings and them just flat out saying that they've seen pretty weak demand for their chargers. Obviously, ChargePoint and Tritium, they're operating similar business models of selling that hardware, but it's not a totally direct comparison since ChargePoint is a lot more focused on level 2 AC chargers, whereas Tritium is more focused on DC fast chargers. But anyway, along with that full calendar year revenue guidance, Tritium also gave guidance for their gross margins for the full calendar year. And they said they're expecting those to be between 10 and 12% for the full calendar year. Now, they told us that for the first half of the calendar year, those gross margins were 4%, which means that for the second half of the calendar year, those gross margins are going to have to be quite a lot higher in order for the annual average to be between 10 and 12%. So I wanted to know what they were expecting that gross margin to be in the second half of the year. And that would kind of give us a better idea of where those gross margins might continue to be more in the long run. Now, based on that information they've given us, I did the math to figure out what they're expecting those gross margins to be, and I got somewhere around 18%, give or take, for the gross margins in the second half of this calendar year. And if I made a mistake with the math here, or if I just completely misinterpreted something they said in the earnings call, please let me know in the comments. Tritium also discussed their target of reaching EBITDA positive in the first half of 2024. They said the major steps they'll need to take to reach that point is to continue improving their gross margins, which we just discussed, and then to keep their operating expenses relatively flat to where they are today. The most significant part of Tritium's operating expenses is their selling general and administrative expenses. For their full fiscal year, they had just under $80 million of selling general and administrative expenses. They also had $15.5 million of product development expenses and lost $4.3 million to foreign exchange. So Tritium still has some ways to go until they start having an operating income. In the past, Tritium has borrowed a lot of money to fund their operations, since they aren't profitable, of course. And those borrowings have cost Tritium about $33 million in interest expenses for their 2023 fiscal year. And today, Tritium also announced they've secured a financing commitment of up to $75 million, with initial funding of $25 million. The reason Tritium needs to borrow all this money is because they don't have much cash remaining on their balance sheet. As of June 30th this year, they only had about $30 million of cash and cash equivalents. So Tritium is in desperate need of new funds in order to keep their business going. Tritium has had to choose between borrowing more money at, I'm sure, pretty high interest rates, or diluting their stock by issuing new shares while it's at an all-time low. So obviously, neither of these are very ideal situations for Tritium. Tritium's long-term success seems to come down to being able to continue growing their business in the short term, being able to use the funds they have right now efficiently, and being able to raise additional funds in the future if they need to. Now, ChargePoint, which operates with a very similar business model as Tritium, also posted their earnings a couple of weeks ago, and their stock hasn't been doing that great either. But ChargePoint is a much larger company than Tritium. I've got a whole video on ChargePoint's earnings, and I encourage you guys to check that video out as well. Thanks for watching this video, and I'll see all of you in the next one.